Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we review August credit card growth, check the August visitor arrival levels, look at where mortgage rates start the week, and we'll wrap up with what the other media are reporting. Last week's data on electronic card activity generally, the data that measures debit, credit and charge cards, indicated July retail activity was picking up. And the latest Reserve Bank data for credit cards partially confirmed it. In fact, whereas the July overall card transaction data showed a rising pace of growth, up from 7.4 to almost 10%, the credit card balance data showed a small correction in August, down from 6.5 to 6.1%. Of course, these two indexes compare slightly different things: transaction values for electronic cards and balances for the credit card component. Slowing credit card balance growth could be due to two factors: lower use of credit cards and debit cards for retail transactions, or credit card holders choosing to pay off their cards faster. The data suggests the latter. Tomorrow we'll look at balance growth that is incurring interest. Overseas tourist arrivals are a key benchmark for our inbound tourism industry, and as we've seen from the guest night data earlier in the month, this has been tracking more positive as the months go by. In fact, August overseas visitor arrivals were up almost 4% compared with the same month a year earlier. In the end of August, there are almost 2.5 million short-term arrivals from overseas. For the month of August alone, there are 165,000, the highest number for that month in the year. For reference, the highest month for a year is usually December, and the highest month ever was December 2006 at 319,000 short-term visitor arrivals, nearly twice the August level. August year-on-year growth is almost 6%, and along with that strong guest night data, shows that the tourism industry here is in good shape. Kiwibank today lowered its 4 and 5 year fixed mortgage rates to 8.65%. This makes them the most competitive bank in the 3 and 4 year rate space, and their rate set does look more logical at these longer terms. Other banks have a carded rate of 9% for 4 years, but 8.6% for 5. No doubt this week we'll see most of them bringing that back into line. But will it last? Maybe not. Just as the rate reductions seem to be possible and timely given the spring real estate season, the money markets may be throwing in a curveball, and a high curveball at that. Wholesale swap rates spiked up at the end of last week. In fact, 4 and 5 year rates were up almost 20 basis points. If these levels hold, perhaps we'll see a cost push higher for 3, 4 and 5 year mortgage rates. The 5 year 8.6% level could soon be 8.8%. By the way, it is our view that 4 and 5 year rates, even if they look lowest at present, are not really a good idea to lock into. We think most buyers should be focusing on 2 and 3 year rates. In 24 and 36 months, there is a realistic possibility a rollover then could be at lower levels, so the overall cost will be better for the borrower not to be enticed into the longer rates now. And finally today, a quick wrap-up of some other recent news. Score 1 for the Fed. Facing both deteriorating financial conditions and new risks to economic growth, the Federal Reserve stepped up to the plate on September 18 and hit more than just a solid single. This one went for extra bases. The question now is, will more be necessary? Business Week is a very useful review. The global credit crunch may have eased a teeny bit, but stubbornly high bank funding costs are still pushing Australia toward a broad-based hike in variable home loan rates outside their Reserve Bank cycle. Could this also happen here? It's another reason why Kiwis have been smart opting for fixed rates compared with Aussies opting for variable. You can get more news and start with Newsmaker Views on our news page. Join us again tomorrow for the freshest finance news on the web. We'll see you then.